The greatest wealth transfers, they don't happen during good times. The greatest wealth transfers happen during downturns. Guys, every time the stock market looks unstoppable, that's when we as regular investors need to worry the most. Right now, stocks are priced like nothing could ever go wrong. And this is what happens when everything collapses. History tells us that. But the problem is that most regular investors, they don't pay attention to history. When valuations get as high as they are right now, corrections in the stock market don't just happen. These corrections slam down hard and they have a really serious effect on us regular investors. The stock market is flashing warning signs. Everywhere you look, prices are being stretched. Tech stocks are dominating and investors are betting on perfection, that everything's going to go smooth and going to go right. In this quick video, I'm going to break down why the stock market, in my opinion, is dangerously overvalued right now, what the numbers really say, and where opportunities may be when the bubble finally bursts and valuations come down. So let's jump into it. First, why is the stock market overvalued right now? Let's talk valuations. One of the clearest ways to measure whether the stock market is cheap or if the stock market overall is expensive is what we call the PE ratio, the price to earnings ratio of the S&P 500, the companies that make up the S&P 500. Now, here's what PE ratio means in very simple terms. The PE ratio shows how many dollars investors are willing to pay for every dollar that a company profits. And the lower that is, the more value you typically have. So most times you hear PE ratio referring to these specific companies. And when it has a low PE ratio, like a 10 or a 12, and it's a solid company, you hear people say that company is undervalued. But when a company has a high PE ratio, you need to watch out because that's when a company is overvalued. A high PE ratio is 20 or over. So here, in this instance, we're talking about the PE ratio of the whole S&P 500, not just a specific company. Now, historically, the S&P 500's overall average PE ratio has been around 15 to 18, right? That's usually been considered a balanced, healthy range over the past 100 years or more. Now, right now, the S&P 500's PE ratio is sitting in the mid to high 20s. For example, and it depends on where you go to get the information. One estimate, you can go, it'll say it's around 27. Another estimate has it at 25. It depends on the different platforms that are used to actually measure exactly what it is. But in plain English right now, investors are paying a premium and pricing in perfection. And when stocks are this expensive, there's very little margin for error. If companies miss earnings, right, do poorly on their quarterly earnings reports, if the Fed doesn't cut the Fed funds rate like Wall Street hopes it will, or if there's a shock in the system, prices for these stocks can fall faster than people expect and faster than you really want, right? PE ratios stretch too far, like we see right now, above the average, they don't stay there forever, not typically, right? And for us regular investors, this fall can be painful, literally, right? Because right now, everything's going good, stock market's going up, looks like everything's working, but you need to pay attention to what's going on in the background. It's not just valuations that are too high. The overall S&P 500 having a PE ratio in the mid to late 20s. It's also the concentration of the S&P 500. Now, let me explain what concentration risk is. I did a video on this a few months ago. Today's top 10 companies that are weighted the most in the S&P 500 are what? NVIDIA, Microsoft, Amazon, Apple, Meta, Broadcom, Alphabet, Berkshire Hathaway, and what? Tesla maybe. But basically it's tech, right? And more tech. If you go back 20 years, say to 2005, the list looked totally different. You had ExxonMobil, you probably had Johnson & Johnson, you might have had Citigroup, Bank of America, right? The point is this, back then you had energy, you had industrials, you had healthcare, you had banks, all of them was at the top 10 of what's in the S&P 500. Fast forward to today, the S&P 500 is basically dominated by tech, right? It's really basically almost one big tech ETF. Tech makes up probably 30 or 35% of the S&P 500. And if tech stumbles somehow, the whole market is going to stumble. That's called concentration risk. Plain and simple. And investors, you're an investor, you have to know about that. Now, just a quick look at what's happening in the economy today that's going to fuel where this stock market is going to go next that you need to be aware of. First, we have the FOMC, the Federal Open Market Committee, the arm of the Fed that meets 8 times a year to figure out what they're going to do with the Fed funds rate. That's coming up here later this week. And most people overwhelmingly expect at least a 25 basis point cut or a quarter of a percentage point. Several places out there are talking about maybe some additional cuts down the road later this year. Some people are talking about a 50 basis point cut coming up this week. I think it's only going to be 25 basis point. Translation, a cut is priced into the stock market right now. There's only going to be a big change in the market if the Fed comes back and says, no, we're not going to cut at all, right? Or they come back and say, we're going to do a 50 basis point or 75 basis point cut, which I don't think those things are going to happen. The market has already priced in a 25 basis point cut in the Fed funds rate. Also, last week we had CPI inflation numbers come out. Inflation remains sticky. Even as the growth of the economy has cooled down, inflation is not going anywhere. Now, this may be an effect of tariffs. It may not be. Speaking of tariffs, let's be honest about tariffs, right? Don't get it twisted. Tariffs have not had the negative effects that everyone thought they would have. But we also know there's lag time too. So we'll see if the tariff effect really shows up. Right now, it hasn't been what everybody hyped it up to be, that everything was going to go crazy. And right, none of that has really happened, and partially because some of the tariffs have been put on hold as well. But the real effect of tariffs sort of remains to be seen. Now, the unemployment rate came out a couple of weeks ago. The unemployment rate for August last month was at 4.3%. And the amount of new non-farm jobs created was only 22,000, which confirms that the labor market is getting softer and softer. The confidence around finding a job is sort of faded recently, right? And more people expect unemployment to rise even more shortly. And then, of course, you got housing, right? Housing has been a big issue as it plays into this whole economic role in the last 6 months to a year. The 30-year mortgage rate did fall to an 11-month low recently, okay? So mortgage applications jumped up, right? Good activity in the housing market, but affordability for houses still is a problem. For most people right now, in terms of buying a home, affordability is not there for a lot of people, especially younger people who are not in their highest earning years, right? And not to mention the supply of money is still tough because of the tightening that the Fed has put on interest rates. Guys, if you're getting any value from this video, do me a favor, smash the like button, and most of all, share this video with someone who you know could use this valuable information. Also, please drop me a comment below and let me know your thoughts. Now, let's get back to the video. Put it together, and here's what you get. The stock market keeps going up, keeps climbing. We see it. I get it. But it's climbing on what I consider to be hope. And the higher that the stock market keeps climbing on hope, the harder the fall is going to be ultimately. That's why I'm trying to clue you guys in as regular investors. You got to be ready for this thing. These are signs, right? The Fed's decision is going to be huge. When the Fed cuts the Fed funds rate, the stock market reaction is going to hinge on what's already priced in. So if the Fed cuts rates by 25 basis points, you're not going to see some big, huge movement in the stock market this week, right? But we'll know more in a few days. We've seen all of this before in terms of high valuation of stocks, right? In 2000, it was the dot-com bubble that burst. In the year 2007, it was the housing and that leverage that broke. Today, it's tech concentration, elevated higher valuation of stocks. And we know that if we look at tech as a sector, those PE ratios for those tech companies are way out of whack, right? You got in the 40s and the 50s and the 80s, right? But that's because of the volatility of tech, right? But also at the same time, it's because of the changing nature of tech. So you have these really high PE ratios of tech that drive the overall S&P 500 PE ratios higher. But that concentration risk on tech is an issue. Couple that with sticky inflation that ain't going down to the 2% mark that the Fed wanted, and this reliance on the Fed to lower the Fed funds rate. Look, every bubble feels safe until it pops. But here's the kicker. Bubbles don't just deflate gently. Typically, bubbles burst. So you got to be ready for it. These are the signs. But there's the other side of this whole story that I haven't really talked about. Downturns aren't just danger. We got to be looking at this from an investor standpoint. These downturns in the stock market and all that good stuff, these can be opportunities for savvy, patient investors. Now, if you built up cash If you got rid of your debt, your bad debt, and you sort of kept your eyes open, been looking at opportunities, seeing what's going on, you'll be ready to buy stocks when everybody else is panicking. Stocks will be cheaper soon, right? Real estate is going to soften soon. The Fed is going to bring down the Fed funds rate soon. Opportunities will open up. You got to know this as an investor. The greatest wealth transfers, they don't happen during good times. The greatest wealth transfers happen during downturns. And this is why, as a savvy investor, you got to be ready. Down markets are coming. Are you ready? This is my plea to you. Don't just survive the storm, but be in a position to come out of it stronger. As an investor, you need to be thinking long term, not just these little quick headlines you see on social media or on the news, on TV, right? That's all to get your attention, to get you to watch. But in real life, investors are preparing when everything looks good because they want to swoop in and get some deals when things go bad. And that's where you want to be at as an investor. So here's the bottom line. This is my stock market warning to you. The stock market is expensive right now. And that is what happens before everything typically collapses. It's being dominated by tech, and the Feds, jobs, housing are all flashing these warning signs that you need to be aware of. You don't need to fear it. This video is not to scare you. You just need to prepare. Review your goals, spend less than you make, get out of the bad debt, build your emergency fund, and don't leave free money behind. Your job offers some type of match, get the match, and then of course sharpen your skills, get your resumes ready. Don't wait for the headlines to scare you. Get ready now. So hey, my goal in this video is just to give you some information that's of value to you as an investor. Do me a favor, smash that like button, share this quick video with somebody you know, and drop a comment below. And look, if you're serious about getting yourself ready for the next collapse, because the next collapse is coming, click on the first link in the description box below and join the VIP early access for my new course, The 4 Steps to Maximize Your Money. You're gonna get an exclusive discount and early access to my upcoming course. Hey, the best person who's going to take care of that old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.